on stage, I'll introduce our next panel. And on this panel, we're going from startup to IPO, one I'm very interested in, working for a startup that is yet to IPO. So funding is critical to the success of the Australian FinTech landscape. From startup through to mature stage companies, the funding journey never ends. As companies grow and scale, there comes a time when outside capital is needed to finance for future growth, execute a full or partial exit for owners, or optimise the capital structure. Join our panel of experts now as they discuss their individual journeys from startup to ASX-listed and beyond, including having the right structures, governance frameworks and processes set up for success. On our panel for this session today, we have Anthony Nantes, CEO of Wisr, Daniel Foggo, co-founder and CEO of Plenti, and Clayton House, CEO and co-founder of digital lender MoneyMe. Moderating our IPO panel today is Amanda Isouard, Special Counsel in the Merger and Acquisitions team at King & Wood Mallesons. Welcome, everyone.
Thank you. So welcome everyone today. As mentioned, today we'll be covering lessons learned on the IPO journey, and we have three very accomplished speakers with us today to assist us on that way. I'll let each of them give some small background on themselves just to start. So Daniel, do you want to start?
I'm just surprised there's not more fintechs aspiring to list in the public markets in the next 12 months, clearly. I thought the room would be jammed. So my name's Daniel. Plenti is fundamentally a lending business, a fintech lender. We've funded a bit over $1 billion in consumer loans. That's the short summary.
Clay?
Thank you. Great to see you guys. Clayton, as I founded MoneyMe in 2013, listed it in 2019. My experience has been in strategy and mass market distribution and M&A stuff. And then for my sins, I thought I'd start a business in FinTech, and MoneyMe was created to fill the gap between banks and customers where that gap was getting increasingly bigger, and a team of about 150 people now doing something quite remarkably amazing in the public eye.
Great, thank you. And Anthony?
It should just work.
It might just work. No?
Dangerous. So I'm Anthony, I'm the CEO of Wisr, public listed company. We're a purpose-driven fintech that's also a lender, but also builds out financial wellness tools and a financial wellness platform. And I've had a slightly different journey to my two peers over here, but we'll probably get into that.
Yes, thanks. And as mentioned, my name's Amanda Isouard. I'm a special counsel in the equity capital markets team. So I've been working on IPOs and secondary raisings for the last 14 years. I worked on the Harmony and Latitude IPOs, and lots of COVID-related capital raisings last year. Probably the most interesting one was the Qantas one. So now moving on to what we're really here for, which is to find out how we all list our fintechs on ASX and what the best paths are for doing that. So there's three themes we want to cover today. The first of those is what each of our speakers expected in the lead up to IPO and post-IPO, and what the actual reality was as a second topic, and then the third topic being tips for founders when considering whether to IPO or not. So Clay, I'll start with you. So you've given some background on your company and the path towards listing, and you had some experience working at Vodafone in different sort of strategic business type roles. But you then moved to working in a fintech. You were a founder of that fintech company, but you'd never been a listed company CEO, which is obviously quite a different environment. So in the run-up to the IPO, what were you expecting for both pre-IPO and post-IPO? And what actually was the reality when you did go through it?
I think when you go through and you take your business from the very, very, very beginning and you build it up, and it needs to graduate, and it needs to come out of, its training wheel environment and get into, the actual real game. And there's a few catalysts for that, and that could be, staff are ready to take that next leap. They're looking for that next level of ambition and learning. or it actually could be the customer profile that we need more capital just to sustain the demand. And in our world, it was both of those things. I had this formidable team that started from scratch. They took a risk on joining MoneyMe because it was nothing. Like, I was paying the salaries out of my own pocket, and it was, but it's a bit sketchy if you're leaving a job to come and join a company like this. But these guys put their heart and souls into an organization that built something quite remarkable in Australia. We saw Afterpay do phenomenally well, Zip do well, and the other guys doing well. And we wanted to not be left behind. We wanted to be part of this Australian, success story. And so I did it for two reasons. One is it was definitely an easier way to get access to capital, to fuel the demand. We're a capital-hungry business. We got bank funding, complex funding structures. We're in equities markets, and it's easier to go and tell the story to a wider group of audience. And people who wanted to listen to us wanted to hear about a public market, and an equities capital market was pretty exciting. Now there's quite a lot of us, but it came in 2009. It came at the right time where people wanted to hear about us. They wanted to hear our story. So instead of trying to go and talk to people about raising capital and almost feel like you've got this tin out in your hand, asking for money, these people wanted to hear from us. They wanted to set up meetings and wanted to give us money. So it changed the dynamic and opportunity for us to really put the gas down and take this thing to the next level. But the staff, you can't pick the timeline that's right. You just know when it's right, where the ability to attract more talent, the ability to give these guys the next kick of excitement, and to feel entrepreneurial in themselves, because they spirited, they wear the MoneyMe t-shirt for those years of hard work. But imagine wearing the MoneyMe t-shirt where they're now really incentivized to do, to work within the business that's, theirs, tangibly theirs. And that you couldn't get prepared for in any shape or form. Now, there's no handbook for listing, Amanda. There's no handbook.
We can give you a handbook.
Yeah, well, I came and asked for that handbook, and I don't know I couldn't understand what you're talking about, but there's no handbook for this thing. At the process, I tell you what, if I could do it again and again and again, I'm sure I'll make, improvements along the way. But by God, it was phenomenal. Like the best experience you could ever imagine. And you go into the starting point, we're humans, and we start distrusting people. You distrust bankers, and I think you should probably still distrust bankers. And you distrust, lawyers and time, and then they talk about this thing
We didn't work together.
We didn't. I always trusted you. And then you think about, then they talk about this thing right at the crunch time, which is who's holding the pen. And you're like, what pen? Like, what pen are you guys talking about? No one wants to write your business plan because you've never written a prospectus as a founder listing a company. You've never written a prospectus. So you're right. I was a strategy guy. I could write any presentation about an existing business, but all of a sudden it was about writing about my own business into the public world and turning, what was a good idea into a 250-page document.
And it's subject to so much more scrutiny than what you'd be used to as well, going from private to public.
Yeah, and some. But when you're ready, it doesn't matter. You enjoy the experience. It's fundamentally you telling the story and using incredibly well-versed advisors to tell the story with you. It's just phenomenal. Hard work, but how long does it take usually? It's a 3-month. It's a really, except if it's latitude, that's like 3 years.
It was 3 times, so it was about 5 years.
5 years. Except for them, you can get it done in 3 months, right?
You can get it done in 3 months. We normally say allow 6 because it's massive impact on management's time.
Also, you guys are lawyers, you bill by the hour, so 6 makes sense, yeah.
Still the same amount of work, it's just whether you sleep or not.
That's why you crunch it in 3.
Yeah, but normally people allow 5 to 6, but you can do it in 3 if you really want to. It's just a lot more pressure and personal toll doing it in 3.
The lawyers will probably bill you the same anyway, so it's...
Yeah. Well, thanks, Clay. No comment. No, thanks, Clay. Now I'll pass on to Daniel to talk about his experience. So Daniel came from a slightly different background where he'd been an investment banker at both Barclays in Sydney and Rothschild in London. So he did have some exposure to equity capital markets beforehand. Yes. He'd held the pen on a few prospectuses. So Daniel, do you want to talk about your path to IPO and what you thought and what actually happened?
Sure. I think what's relevant in terms of pre-IPO is, we built the business up over 5 or 6 years, and it was primarily with family office and private equity funding. So the IPO, from my perspective, was really about a shift from that sort of funding to obviously being in the public markets. And I think it's interesting, some of you in the room have probably got VC or family office or private equity funding, and I think there's a lot of value that can come with those sorts of investors. We certainly had private equity executives on our board that were really engaged, were really putting their mind to how they could help you as a business succeed and lay the right foundations. So, the move to being in the public markets was driven by a need for capital. We were growing in such a way and moving to a source of funding where we needed to put our own equity into some of our loans, so we needed the capital. So it was a very natural progression to move from a private equity world into a public markets world. And I think in terms of, to answer the question, which is, what were you expecting pre and what was the reality after, there's a couple of points I'd draw out there. Is I think when you're a private company looking to IPO, you sort of say, look, when we're a public company, we'll operate the way we are and we'll just be completely, commercially focused, and, we won't let all the sort of, the governance of being a public company get in the way. I think the reality is that when you do become a public company, you shift from just being super or uber focused on the commercials of what you're doing and how you lay the right foundations to having another set of considerations which take up a lot of your time and also take up a lot of the time of the people on the board and the people around you. So one observation I'd make is one does miss the engagement you get from shareholders of private equity investors as a private company. So they can obviously be a pain in the neck sometimes when you're actually in that position, but I wouldn't take it for granted. They can add a lot of value. And then I think in a public company environment, there's pros and cons, obviously, to being in that environment. And I think one of the cons is actually something that you're told, which is a lot of your time will be devoted to, speaking with investors, governance, those sorts of things. And it's probably 25 to 30% of your time. And, you're already pretty busy in a private company. You add that into the mix, and I think that, it's really important you've got the right team around you. It's really important you learn some new delegation skills, and that can take a little bit of time. So despite knowing the changes that would be afoot, I think the reality is also, I wouldn't call it a shock. It's you're learning as you go over the first 6 months around how you reshape your own business in terms of people and how you reshape your own time. And on that, we hired a really experienced ASX 50 general counsel as part of that process.
Yeah, I agree. It's very important, as you both said, to have the right people around you the whole way through. And it's definitely an experience that I think, as Clay said, is worth considering seriously. Anthony, I'll bring you in now. And so you had a very different path towards listing. Do you want to talk through that and also your experiences?
Yeah, so quite different to the guys here in the fact that we did a backdoor listing back in 2016. So we took over a shell that had $5 million of cash in it and a $5 million market cap. And that was kind of on the back of me approaching a bunch of people, this is back in 2016, with a business plan that basically said, I need $50 to $60 million over the next few years to take on the big four banks. And the world's changed a lot since I think when we started, but at that time, that wasn't really a plausible pitch to anyone. There wasn't really structures in Australia to raise 50 or 60 million. There wasn't the kind of VCs and follow-ons and the kind of structures that you could credibly say, I'm going to get that money through. Well, I didn't think so anyway. The others have proven to be the case. So we did it that way. We started with $5 million and started being listed and have grown the company from there. Which I guess, if I had my time again, would I do it that way? Certainly the early days were very, very hard. Being a very small, loss-making company that's capital hungry on the ASX is a very, very tough place to be. I was lucky in the sense that one of my best mates is Larry Diamond, who ran Zip. He'd done it quite successfully. I spent a lot of time with Larry getting tips and advice and coaching from him around how to kind of navigate some of that, which was incredibly useful. And ultimately, it's proven to be successful. So we have gone on to raise about $60 million over the course of that time, and have gotten the business to where it is today. But there's probably a couple of takeaways from that. One is that there's no right path. You know, eventually we all end up here, but for anyone who's sort of starting out, what it means is there's no one answer. There's actually multiple ways to get to an endpoint, and I think the way we approached it was quite different. I think these days, I think the Australian investment community is much more mature, and so the idea of doing what we did back then is probably much less advisable. I think. I'm not saying it's not still doable.
It still happens.
It still happens.
Frequently.
But I think there's more genuine money that can back you to big numbers, and even if you're asking for a business plan that says I'm going to need serious capital to make this thing work down the track, there are structures now in Australia that will support that.
Yeah, people are, I think, more willing to take risks, and with new investors or new fintechs or other companies they don't know, they're willing to put some capital in to help you along and follow
Well, I think,
the journey.
and just write bigger checks. I mean, that was the, I think, back then, I think the other guys probably just took a leap of faith that eventually there'd be people around that could write those size checks. But back then there wasn't, though, I would say. And I think today there are. There's absolutely people who can write. I mean, and the US firms are looking more at Australia. We saw Tiger just invest into his stake with $40 million. So, it's just a different world now, I think, in terms of the private market and the size of check you can get in the private market. It does take a lot longer. The big advantage of being public is that we can raise capital in 2 hours. By and large, it's not entirely true, right? It's 6 months of work to do it in 2 hours, but eventually you do it in 2 hours.
But now that you're listed, you can raise it in a couple of days. Yeah. And so you're glad you're no longer private?
Well, I mean, we were never private, right? That's the thing. We started listed.
I mean, just like, yeah.
Yeah, look, there's just pros and cons, right? I mean, there's things that we could do if we were private that we can't do if we're public. So there's higher risk, probably longer term strategies that I think when you're private, you can, if you've got the conviction of longer visionary shareholders and VC type funds who will back you into like a 3-5 year plan with the capital to do it, I think you should stay private. I think if you can deliver a business that has the ability to deliver short-term outcomes or shorter-term outcomes, because that's what the public market demands. It demands quarterly outcomes, by and large. So I think if you've got a business that can do that, then the public market's a great place to be.
Great, thank you. Before we go to questions, if each of you had to give one tip to people looking forward towards potentially listing on ASX, what would that one tip be? Daniel, do you want to start?
I think you've got to have the right business to be listing. So you need to make sure you've got really strong foundations and real confidence around where you're going to take your business, because I think the last place you want to be if you haven't got the right business with the right foundations is in the public markets.
Thanks. Clay?
I can't give one. There's too many, man. I want to see basic on the boards. I want to see split on the boards. I want to see WeMoney getting a crack at it when they're ready. You've got to do it. If you've got the gas and the entrepreneurial spirit within the team, you've got to give it a crack. It's phenomenal. The experience is something special. And once you list it, get a good CFO that can tick the box and tell you the 20 different committee meetings and, get through it properly. That's all fine. The beauty about it is you'll learn so much because you're talking to about 50, as an entrepreneur, you're talking to about 50 different people in a week. And these people with new perspectives and global ideas, it's just an untapped source of inspiration. I'm learning about ESG. It comes natural to guys like me that are new to Australia and have got diversity at the core, and we think about things differently, and the average age of our staff are 28. But when you start learning more broader about your social impact and your environmental impact, and you're starting to create this wave of change, your fundamentals as an entrepreneur start changing. You start finding new inspiration. It wasn't just about the customer. That's always going to be there. It wasn't just about the product or the innovation or the team. It actually keeps going. It keeps going. And that's the thing I'm going to say is if you're not IPOing to sell a whole bunch of your stock, but you're IPOing to give more people an opportunity to buy into your business and help you through its next 10-year journey. Like, come on, like, don't waste time. Get going, man. Basic split, you guys get going. We want to be part of your success story. And that's what it feels like. Sitting in this chair, I don't worry about the other parts. The other parts are easy. Like, there is a handbook, you know. The CFO is going to give you the handbook. The general counsel is going to make sure the CFO is giving you the handbook. Everyone's going to make sure something's happening. What your job is to find that next inspiration, and your ambition gets loftier and loftier. Like, I'm 8 years into building MoneyMe. I genuinely feel like I'm in the first 5 minutes of the first quarter of this game. And that's what you want as an entrepreneur. You don't want to feel like you're going to the public or to the market and asking for money, because that's going to take the wind out of you. IPOing or being public gives you this boost that you cannot even imagine. And your staff will be so connected to what you're doing, you won't even imagine what your business looks like. Sorry, that wasn't one, but...
I feel like one of those sports movies.
Yeah, there's no way I'm going to do one either. So that's, so I'll probably do three. I think there's three things that I would think about, and Clay's enthusiasm is contagious as always, and I think there's an element of that too. Look, there is the opportunity for the fintech world to create many billion-dollar companies on the market, and I think we need that. Like, what would help us is that more of you do this, and we create a real investable system, an ecosystem, or a group of companies, a portfolio of companies that people can look at and go, these are all going to become billion-dollar companies, because the opportunity is all there for all of us, right? We know that the incumbents still do most of everything, so there's lots of room for all of us to go and build really big companies, and the more that kind of get onto the market, it makes it better for all of us, and success drives success, and we can replicate that. I think the second thing I would say though is that as a fintech, the governance part is important. You have a slight advantage in the sense that you're so regulated anyway. If you're working in financial services, you have to do a lot of governance. So you kind of got a bit of an advantage. If I was talking to a pure tech conference, which I do sometimes, and you're running a SaaS platform and you're running a tech company and you're thinking about listing, I'm like, well, you're going to have to build a whole bunch of governance stuff that you don't currently have. So there's a bit of advantage by being a fintech because you're already doing a whole lot of regs and stuff, and you've got all that governance built into your company, which does help you list. I think the third one is just the people aspect. You know, we were lucky enough in the last little while, the AFR named us the sixth best company in Australia to work at. That's the thing that I think can get distracted, right? The public market can distract you as a leader and your leadership team around short-term outcomes, around investor expectations, around analyst expectations, and that can get really, really distracting. And that distraction as a leader can get felt down through your company. And so I think one of the things I'd say is staying really true to being a great leader for your people and making it a really great place to work. Because if you make it a great place to work, then the rest of it, as we all know, generally takes care of itself.
Thank you. We've got time for a few, maybe a couple of questions. Is there any audience questions?
Hey guys, firstly, oh my gosh, that was so amazing. I feel, just all of you kind of answered a lot of what I was going to say. One of the things you guys are talking about is the whole journey to get there. But one of the things that I find, even just investing in shares, is, you know, you get really excited, you know, a company's going to have like a huge earnings announcement or they're launching a new product and you go and check your portfolio and you're like, oh, didn't really reflect. I'm not sure, Clayton, if anything really gets under your skin or if anything bothers you, but maybe it does. But I asked the whole panel, how do you deal with, not just for yourselves, but for your employees when you're like, guys, we're just like launching this rocket ship, we're going in the right direction, we believe in this, and then the news hits the market and it's a bit of a, partly how do you deal with it and keep them motivated? Anthony, you sort of answered that already, but also how do you keep yourselves accountable to your vision and being like, I know I'm on this right path? I think just sort of after the fact, after the IPO.
I'll pick up a little bit and then let you guys... I often quote Jeff Bezos because I think he's very, very clever, although I don't admire him necessarily as a human being. But I think he's very, very good at what he does in business. And one of his famous quotes is, you know, when your share price goes up 10%, in a couple of days, you're not 10% better. And when your share price goes down 10% over the course of a week, you're not 10% worse. And so just making sure that everyone in the company understands that it's not actually a scoreboard. It's not actually reflecting what we're doing today. It's actually quite disconnected from what you're doing today, where the share price is today, is actually quite disconnected from what you're actually doing that week. It's much, funnily enough, the share price usually reflects way back something historical, your last kind of numbers, or some prediction about where you're going to be. It's very rarely reflecting what you're actually doing in the present. And so I think just keeping that conversation live in the company to say, let's try to ignore it as much as we can, because it's not reflecting our performance. It's not a measure of how good we're doing this week or at any point in time. As much as you can. It is hard to do though.
Yeah. It sucks, right? You go and you say, bam, outperformed everyone. You can see the trajectory. This thing is the behemoth it's in making, and there's no denying it. First to be profitable, and you go and you say, bam, and then the stock market and the price goes down. You think, shit, okay, mistake. Obviously, my language in the way I wrote it is a little bit, everyone's got an opinion why it happened. Everyone will tell you why that happened. And you do it again, and everyone will tell you again why that happened, and again, and again, and again. And you know what? It genuinely just makes you work so much harder. It's awesome. It makes you work so much harder because you want to defy those people that sold out so early. You want to celebrate the guys that bought in cheaply, and you go, bam, yes. And the energy just keeps going up and up. Because there's no doubt it's $1 billion company soon. There's no doubt. But what I'm excited about, no doubt.
That's not guaranteed.
It's not guaranteed, but no doubt.
No guarantee.
No guarantee. But to answer your question, genuinely, the storyline isn't that short for us. When you're in the organization and you're seeing the products evolving, you're seeing the spirit of guys that they're going to be there for at least the long haul. It doesn't matter what the share price does today. It genuinely is. It's almost laughable because it doesn't matter. We're so excited about how we're going to tell our next story and how we're going to show these results and stand out from above expectations that it just doesn't matter. We think the capital markets will catch up. They always do. And I think we're such an early stage business, we're in that first few minutes of our first quarter, that it doesn't really matter what the price is right now, because it's not what the price, I think, is supposed to be at a point in time.
I'll just extend on that and say it's about making sure your team understands where you're going over the longer term, and share prices short term, and we're in the small caps here, so they're not the most efficient markets necessarily, but if everyone's focused on the long term and they've got the right long-term incentives and everyone sees you making traction towards your longer-term goals, then I think you discount what's happening in the short term and you know where you're going, and I think you then have an understanding of how the market will value you once you get close to your goals.
I think the other good side of it is it's quite humbling too, right? And you guys would have probably experienced this too, because it's quite humbling when you feel really confident, you've delivered great results, the market doesn't respond, and it's kind of sometimes that's a nice reality check for you to say, you think you're doing this stuff really, really well, but it's not enough yet. So I think that can be a good reality check for you, and like Clay said, it drives some passion and hunger to say, well, we've got to do more then, right? If that's not enough, we've just got to do more.
Well, thank you, everyone. Thank you for the question, and thank you to our panel. I think it was a very interesting and informative session, and hopefully everyone takes something away from that. So I'll hand back.
Thank you, everyone. And yeah, I definitely got out of that session that we can all be unicorns. So exciting times for all of us ahead. We'll move on to our